Okay, hi everybody. It's Friday, October 21st, 4:15. On my own today, so I'll take you through a bunch of slides, of course, as per usual. Since we'll be talking by myself, I have something around 10 or 12 slides to go through. Lots to cover. One of the research firms that I follow is called GMI. It's written by a guy by the name of Raoul Pal. And every once in a while, he puts out a big chart piece. This particular one was about 150 pages, I think. So I stripped out 10 that I wanted to cover today and go through just where we are in the cycle, what's happening, what's going on, and kind of take you through where I think we are in this process and what I think is ahead based on some of those things. So pretty decent week for stocks this week, and decent close here. As I look, we got the Dow, Nasdaq, and TSX all in the green, with the Dow and the Nasdaq up about 1% more than TSX. So we'll go through that and cover a bunch of other things. Great start for the Senators as well this week, so certainly happy to see that. So without further ado, just going to jump into the presentation here. Just bear with me, make sure we get this screen up. Okay. Okay. All right. So I'm going to cover a bunch of things, but earnings per share, which is, I think probably something I wanted to touch on, and we're going to go through, which I'll talk about, what's happened to earnings per share, what's happened to forecasts, and then we're going to talk about ISM, which is a reading that they use to say what the health of the economy is versus the Fed's fund rate. Talk about real yields, because there's been lots of discussions around we need positive real yields, and what that looks like on a kind of looking back versus what that could mean in front of us. Also compare ISM to bond yields and a historical look at that. We'll look at a couple of periods that are similar to what we see today. A view of employment, which is really, I think the last few weeks that I've been talking about it, is something where I think it's kind of that last thing that the central bank's been using to say we're going to hold off on stopping rate increases. And as you know, the employment is backwards looking data, so we're going to cover that, and then have a quick historical look at bonds. A couple other things before we wrap up. I could have put up 100 slides, but we'll strip it down to 10, and we'll go from there. So the first thing that I wanted to just touch on was just earnings per share, changes to earnings per share through the different industries. So S&P 500. So this is an update. Obviously it's a bit of a busy slide, but don't want to hit on each individual category more than to look at, earnings per share has been revised down in the most recent quarter, and forecasting guidance has been revised down as well. So these tend to be leading signals. We've seen inventory builds in a lot of places as well, with Nike and Under Armour and the other consumer discretionary starting to see inventories build up. So forwards looking earnings per share is slowing, which tends to the price of the stock's already fallen and EPS has fallen. Once those two kind of match up is kind of best point of execution from that perspective. And so this is the ISM, which would be the right line here that we'd be looking at versus the Fed funds rate. And so I've been talking quite a bit over the last, I'd say, 3-6 months, really just about trying to understand what happens to rates, how long they're going to go, how high they're going to go. These things we can't predict. But the one thing we can do, at least looking backwards, is when and how do rates move? What do they look like? How often do we reach equilibrium and stay there for an extended period of time? And so if we look at the blue line, so since 1970, this is rates and how they've moved. So one of the things that you'll see is when we do peak in the rate cycle, it's a very brief period of time where we actually stay in that. In most cases, actually, you get a peak followed by a cut right away. What we've seen in the more recent period, at least since 2000, is you'd get a couple of months of a neutral followed by consecutive cuts. Again, if you look at through all these periods of time, there's been a very rare point in time where we've actually stayed at kind of what I think the Fed talks about, and most of the central bankers, and I just excuse me, this is Fed data, but if you look at central banks around the world, quite similar, is they get to an equilibrium for a very brief period, and then you get consecutive cuts on the back of that. So right now, every point since the mid 60s, when you had ISM drop to that, we'll say, dotted line, drop below that 50. You've had rate cuts from central banks. This one particularly is the US central bank. This is a little comment just on real rates. So if we look at what this says, so this is the real rates long-term trend line since 2000. So if we look at what this says, every time real rates go positive, the government needs to fill the revenue income hole in order to be able to service the debts. And so where I think there's quite a bit of commentary that says real rates need to be at X for X period of time in order for that inflation number to come down. You know, the other side of that equation is real rates are actually quite detrimental to GDP, and GDP slowing and a recession historically has always caused inflation to come well within the 2% and actually tends to lead to deflation. So I think this real rate move that we've seen, which is 3 standard deviations outside of its long-term average, we need to pay attention to this. And I think the income component to this is as important as the inflation narrative that we're seeing right now. Okay, so again, similar. This is 10-year bond yields, which is the blue line, and then this is the ISM, which is the health of the economy. And the divergence we've seen is a historic divergence. If I showed you Germany or Europe or Japan or Canada, we'd see the same divergence, which is yields have moved up, ISM's moved down at its fastest pace in history. So this is something we need to pay attention to from the perspective is I think we're quite a bit closer to this kind of turn from a bond market perspective. And I'm not saying, we've talked a little bit about the Fed pivots and such, but I think it's more the market is starting to react to certain instances. And I think that's what we need to pay attention to today. And so if we look at the US unemployment rate, what GMI and RAL has developed over the years is an employment leading indicator. So it's a basket of a number of different inputs to provide guidance on the expected over the next 6 months, where unemployment tends to move towards based on the data set that they have right now. And so if we look at it today, we're starting to see an uptick in unemployment. And so if we look at the guidance, I mean, if you have the view that we're not in a recession, then you won't believe these numbers. But if the view is that we're currently in one and we have unemployment start to tick up towards the 6.5 in the US, like these are forward guidance numbers that we need to think about. And why we need to think about them is that these tend to drive what the central banks and politicians of the world will do, either fiscally or monetarily, from a decision making over the next couple of quarters. And so if we look at a couple of historical points, this one on the left here that we're looking at, which is probably most similar today when we look at the setup perspective, is we see a multi-point move in the US 10-year yields. And so this was kind of the mid 90s where we saw this. And then what happened subsequently after that, this was the type of action that came on the other side as the recession ensued in that period of time. And if we look at where we are today, this is what we've had with US 10 years, had multi-level moves to roughly where we are today in US 10 year, which is 4.2. And then we saw subsequent moves lower. This was a chart from the mid 60s where there's a number of comparisons to the similarities of today. Again, multi-step moves up to a high, and then as the recession kicked in, you saw yields move dramatically lower from this period of time. And so I'd say based on the data we see today, I think we're extremely close to this happening. So this is a counter trend argument. And so if we look at this, this is consumer confidence. This is U.S. Consumer Board confidence for their expectation for where rates are going to go over the next 12 months. And so this is an inverse indicator from the perspective is, if you look at this, at least from 1990 to today, every time there was a high level of expectation for rates are going to be higher in the next 12 months, the exact opposite happened. And so as we start to come up here, as we got down here, they thought rates would continue to lower forever, which is not the case, as you know. And now we've reached the 70 percentile again. And so we're starting to, people believe that rates go higher for the next 12 months. It tends to be an indicator that says the opposite is true over the next 12 months. A couple other things, just want to touch on the US dollar, which I've talked about fairly frequently here. And I think it's really hard to understand the magnitude of the move and where we look right now. If you watch at least on CNBC or BNN, you get everyone quoting the DXY, and the DXY is a basket essentially against the US dollar, which the euro being the biggest input for that. And so if you look at that as a standalone basket, you're looking at the US dollar is up about 18% globally year to date. Historically, that number is massive, and it's really just a show of how much US dollar is needed in the system right now and is getting sucked out on a daily basis by financial tightening that's happening globally, not just in the US. And so to give you context for what that means, this is the Japanese yen versus the US dollar this year. And so you've had the yen fall 40% versus the US dollar because Japanese government is doing what's called yield curve control. As they said, rates will not move. And so they'll put money in the system always to keep that keep that Japanese 10-year essentially at zero for the foreseeable future. What that's resulted in is a 40% depreciation in their currency just this year. And so, I've commented a little bit on this. At some point, we're going to see this turn go in the other direction, and you probably get a pretty material reversal in the US dollar against most major currencies globally. But at least right now, the pressure's been up against the global currencies of the world as financial conditions have tightened. And so this is, as I mentioned, this is a picture. So this is ISM versus DXY. And so presently right now, if we look at what this move has meant, is it essentially is pointing towards the ISM heading towards 35. So this is a chart to look at and say, the DXY, which is US dollar, has already priced in an ISM of 35, which means that the DXY is already priced in the recession, at least from a US dollar perspective today. And so this is a historic move from a deviation perspective. And so, if you look at this, there's so many different inputs to think about, but the majority of these that I've shown today is saying we're actually, at least based on where certain things are today, US dollar, stocks, currencies are pointing us to the fact that we're quite close to the bottom of this move in currencies and yields, and the market is starting to say to us, there's a high probability that rates go on hold sooner than is priced into the market currently, and we have to continue to watch this because these are things that Powell will be looking at to say, how much has this impacted us? How much is this impacting our income? And the politicians of the world, once we get on the other side of midterms, will also be looking at these numbers. And I think that they'll play a material part in what happens after midterms and for the first quarter of next year and up until the end of this year. So that's just a quick update on all the charts that I looked at today. Just want to put one thing here. Obviously, there's always continues to be certain things happening in crypto, which I try to update, and Bitcoin. So Ethereum switched from their proof of work to proof of stake. And so there's been lots of negative press around the impacts of, well, say crypto mining. And so just that conversion from that proof of work to proof of stake has actually reduced their carbon footprint by 99% by making that change. It's gone quite well. And so that's certainly something interesting that I follow on the movement on how things are progressing in the blockchain space. So thanks very much for everyone listening today. I do want to provide just kind of a brief summary. I know I said quite a bit in a short period of time there, but there's continues to be more and more things pointing towards, you can't ever know when things are fully priced into assets and so on and so forth. But as we look at what's happening and we look at what the central banks have been saying and doing, they're starting to tell you that we're getting closer to the end of this from a cycle hiking perspective. We had our CEO of National Bank speak to us yesterday, and his view was that there is in the U.S. One more rate increase, and he thought the same was in Canada. So interesting perspective. It's more aggressive than I have been. I think that we'd see a little bit more happen here. Presently, right now, the Canadian Bank of Canada meets next week on Wednesday, and right now it's priced in a 75 basis point increase. So that's something in the neighborhood of 90% priced in right now. And then the US Central Bank meets the first week of November. And you're looking at, again, something in the neighborhood of 70 basis points is priced in today. So as we look at that, we listen to what they're saying. There's a lot to cover between now and then, but on the positive front, a lot of the indicators, at least the forward indicators that we look at, and that's really how stocks, bonds, risk assets are priced, are telling you that a lot of this thing has been priced in today. And I continue to be patient and watch. There's new stocks each day that hit 52-week lows, and we continue to be patient. But the more that I see and read and look, we're starting to get a lot closer to kind of the end of this rate increase. And if we listen to some of the other things that are happening around the world, and I had a client send in Louis Gavkal's research yesterday or today as well, just thinking about what's happened in China, and China's been in their lockdown phase, and we're starting to see them come out the other side of this, starting to open things up. And so, if you get a combination of events happen over the next quarter, that we could be sitting in a much different position than we are today. So I'm actively looking at how do we start to deploy, make changes, really tweak, and make sure we're best positioned for what happens in the next quarter or two. And I'm quite optimistic for where things are and where things are going. So if anyone doesn't have any questions, I'll wrap it up there, but I'll leave a minute here if anyone has any questions. All right. Well, thanks everybody for listening today. I hope everyone has a great weekend. Looks like it's going to be a beautiful weather for a nice kind of last weekend in October. So nice to see you all here, and thanks very much for joining me, and take care. We'll see you next week.